Today, digital currencies turn lower even after the U.S. economy returns to growth. Core Scientific says it could be heading for bankruptcy if the crypto bear market continues, and Solidus Labs finds hundreds of thousands of smart contract scams. Welcome to CNBC's Crypto World. I'm Jordan Smith. Digital currencies sliding today even after the release of new economic data showing U.S. economic growth has turned positive for the first time this year. By noon Eastern, Bitcoin still maintained the $20,000 level, Ether held on to $1,500, and Solana dipped to $31. All right, let's catch you up on the top stories. First, Bitcoin miner Core Scientific says it could be close to filing for bankruptcy. In a disclosure to the SEC, the company cited Bitcoin's huge sell-off, the rise in energy costs, and an ongoing lawsuit with Celsius as some of the reasons its business was struggling. And because those factors hit its cash reserves so hard, the company's board decided Core Scientific won't make debt payments in October and November. Now, the company says it's exploring several options to raise new capital, but if those alternatives fail, Core Scientific warned it could resort to bankruptcy relief or restructuring. As a result of that disclosure, Core Scientific's stock plummeted more than 70% by midday. Next, while the bear market might be hitting crypto businesses, it looks like institutional investors have seen it as a buying opportunity. New data from Fidelity Digital Assets finds that 58% of institutional investors bought crypto in the first half of this year, while 74% plan to invest in the future. Kate Rooney got the chance to speak with Chris Kuiper, head of research for Fidelity, about that data.
The people who come along on this journey, who really put in the work to understand this value proposition, to understand how it works, they're the ones that are thinking about it more tactically and using this as an opportunity to perhaps take a position or add to a position. So they're not the ones that are looking to trade on news or sentiment or price action, but to really build that core position. And of course, now is a lot more appealing than a few months ago. Macro remains in the driver's seat for this asset class as central banks around the world continue to tighten. That makes something like a Bitcoin store of value narrative look less attractive as real rates go up. But if that were to change, if central banks would have to turn around at some point, we think those core value propositions would come back into play and again, once again, look more attractive to investors.
All right, on to our main story. Crypto market surveillance company Solidus Labs is also out with a new survey today, and this one tracks the rise in crypto scams. Solidus found more than 180,000 smart contract scams across 12 blockchains as of October 10th. Crypto World's Tanea McKeel spoke with the company's co-founder about that new survey.
All right, thanks for joining us. We got this data from you showing there's a newly deployed scam detected about every 4 minutes. So I want to dig a little bit further into that data, but to start, what exactly are these scams? What exactly is going on?
Our data and the insights that come from our analysis is quite striking, in my opinion, and reveals a real phenomenon of hidden theft that is larger than I think many people realize in crypto, but it's also an opportunity to really understand what's going on. Sunlight is the best disinfectant, and get a much better understanding of crypto market integrity and how to improve it. We're talking about basically around over 180,000 smart contract scams that we have now mapped and flagged for users and of course for crypto exchanges, etc. Essentially, they're cryptocurrency tokens that's actual code is pre-programmed in order to take money away from users. How does it happen? Essentially, a scammer would deploy one of those tokens, oftentimes as some sort of a meme cryptocurrency, give it a cool name, something that is currently buzzing in the industry to attract attention, deposit some money into it to make it look legit, and then essentially wait for people to start trying to invest in it. As you can imagine, within over 188,000 kinds of scams, there are a lot of different ways in which scammers make sure that the users who deposited the money cannot withdraw them. The umbrella term that a lot of people call many of these scams is rug pull, again, because you pull the rug under the users. And one of the most troubling thing about it is, we hear about the very big scams. Those get reported in the news because, they're big headlines. But what we found is that, as you mentioned, new scams like this are deployed on the 12 blockchains that we're covering, including Ethereum, which of course is one of the most important ones, every 4 minutes. Oftentimes, the scammer would leave with $30, $40. It doesn't sound like much, but it happens every 30, 40 minutes over and over and over. And as you can also imagine, at least I imagine, people who invest $30, $40 are usually the ones who can't invest much more. It's just a shame, especially because there's so much opportunity in crypto to allow opportunities to make money and invest, those scams, in our opinion, just damage the potential of the industry. And of course, part of the reason we're reporting on this is because we want to help prevent it moving forward.
Where are these scams taking place? Is it specific blockchains? Is it happening via certain exchanges?
So first of all, very important to say that those are on-chain scams, meaning that they happen in decentralized exchanges versus centralized exchanges. Our solution that, of course, helped generate this analysis it covers 12 different blockchains, including, as I mentioned, Ethereum, BNB, which is Binance Smart Chain, Polygon, and a range of other ones. Now, according to the data, about 8% of all tokens on Ethereum are hard-coded scams. And again, it's really important to emphasize it's certain because it's based on the code itself. Of course, the technology just scans through the code and knows, because of the work of our team, to just recognize when there's no reason that a piece of code would be there if this was a fair investment opportunity. So as I mentioned, 8% of Ethereum, which is dramatic because in a lot of ways, Ethereum is considered the foundation of Web3, which of course, carries a huge promise. BNB, the Binance Smart Chain, it has a ratio of about 12% scams. That's the highest one. But those scams are spread across multiple blockchains and through that many different kinds of tokens.
How does this data compare to, I don't know how far back you've been tracking it, but it is a bear market. It's been a bad time across crypto and all risk assets. Has there been a significant upswing compared to before this bear market?
As you can imagine, the more money flows into the system, the more buzz is out there, the more manipulators and scammers would try to take advantage of investors. Usually when there's a lot of buzz, people make quick decisions, don't necessarily think about it as much. And it is complex to understand, which is part of why we're trying to provide this simplicity. There was a very large increase that coincided with the increase in volumes across the Ethereum, across the decentralized finance ecosystem during what we call DeFi summer. As volumes decreased, the number of scams actually didn't necessarily decrease, but there is a correlation there. We do believe that putting this out there at the end of the day is going to help preventing them. One very important reason is that at the end of the day, if a scammer was able to steal $30, $40, it's important to remember that it's not cash, right? It's $30, $40 worth of that token. Usually they would transfer it to another token that they can try to funnel to a centralized exchange that offers exchange into dollars. Based on our numbers, not too far from $1 billion of money affiliated with those scams ended up one way or another in centralized exchanges, and therefore potentially actually made it into the hands of the scammers in a way that they can use. So while to your point earlier, while this happens on decentralized exchanges, the relationship between the decentralized part of the crypto ecosystem and the centralized part of the crypto ecosystem, what we call CeFi, is very important. Having this information, having this map of all of these scams, and the fact that it's the system constantly identifies in new time when new scams are out there, really allows crypto companies to keep track and prevent those funds coming from scams going into centralized exchanges, therefore making it significantly less lucrative.
All right, that's all for Crypto World today, but we'll be back again tomorrow, and we'll see you then.